Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Where is the Federal Reserve going to go? We've had a lot of economic data out there that I guess with the hindsight still looks okay. But boy, if you look at some of the survey data, whether it's the UMich data from a couple of weeks ago, which we'll get some updated UMich data on this Friday, whether it's some other survey data, it shows that the consumer's a little bit concerned out there. Inflation expectations a little bit heightened. So how does the Fed take that into account? Well, I know Danielle DiMartino Booth, she'll have some thoughts here. She's the CEO and Chief Strategist at QI Research. Danielle, what's the data you're looking at to give you a sense of where this economy really is today, maybe where inflation expectations are today? Because the Fed probably needs to be a little bit nimble here, don't they?
Yes. Good morning, and thank you for having me. And absolutely, the Fed does need to be nimble. We actually saw with the durable goods report that came out, kind of the first hard data that agrees with, across the board. Every single regional Federal Reserve survey has shown reduced capital expenditure planning going into the future, reduced employment going into the future as well. And most of what we've been seeing has been, as you said, soft survey data. Now we have hard data to back that up with this morning's report. And so the Fed's going to have to start thinking. The Dallas Federal Reserve did some great work about a year ago that showed that it is investment, business investment, that leads the U.S. economy in and out of recession. With the looks that is going to be turning down, and again, corroborated by every single regional Fed survey, all the way down to the Richmond Fed and Philly Fed that we've had these last few days, the Fed's going to have to become more concerned, as we saw in that CFO survey, about the possibility of recession. So they're going to have to balance the two when they're making their policy. There's two non-farm payroll reports before they meet again on May 6th and 7th.
And that's what I was going to say. It's 6 weeks away before we get the next Federal Reserve decision. And you were mentioning those key economic data points that are going to be coming ahead of that, as well as that reciprocal tariff deadline on April 2nd here. So what's the playbook, you think, ahead of this Federal Reserve meeting? And what do you think needs to happen in the data, depending on what could force them to move in a particular way?
So, given the magnitude of the Challenger grain Christmas layoffs, 172,000, only 62,000 of which were attributable to the public sector in February, we're at about the same run rate. We're running at about 150,000 layoffs announced in the month of March. It's looking like the Fed might get to that 4.4% year-end unemployment rate target by the time they meet again. So I think that the real risk is that Powell's going to have to pivot again in favor of the employment mandate if what we're seeing on the ground with layoffs and, of course, BCY Go bankruptcies running at about a 22 pace for 50 million or more in liabilities on the terminal that you can follow. They're going to have to start paying more attention to what higher for longer is doing to the real economy.
So what is the focus here right now, if you think of the Fed, Danielle? Is it inflation? Is it employment? How do they balance that these days?
So they're definitely focused on inflation expectations. We saw a fairly dovish voter, Austin Goolsbee, saying we really have to pay attention to see if these inflation expectations become unhinged and start to filter their way into the actual inflation metrics. But we haven't seen that yet. And the fact is, what we're hearing from one company after another is that there's a margin squeeze going on. They are having to deal with higher input prices. There was a lot of stockpiling ahead of the potential for imposed tariffs. Not that we know what they're going to look like yet, but companies are reporting one after another that they cannot pass through these prices to the end consumer, whether you're talking about Walmart or Dollar Tree.
That's interesting, too, because when I've talked to Tom Barkin before at the Richmond Fed, he talked about how he would actually look at the price mix volume when you're looking at a lot of these companies and consumer packaged good companies, whether it's like a Coca-Cola, PepsiCo, Kraft Heinz, and especially what it was meaning for inflation and things like that. What do you like to look at? Because, I mean, you have so much experience. You previously were an advisor at the Fed Bank of Dallas during the global financial crisis. So when you're looking at some of these key consumer type names and what do you think it could mean for inflation, and other forms of growth on the other side of the employment thing. What are you watching there?
So, I think everybody's focus right now is on consumer discretionary. But to Barkin's point and to your point, we're actually seeing the staples come under pressure because of what we've heard from some of the lowest cost retailers out there. And that's that some U.S. households are even beginning to cut back on essential spending. They're moving away from brands. They're moving away from packaged goods, whereas these companies were able to pass through these prices for several years following the pandemic. Now they're hitting a wall. McCormick was the latest to come out and make those types of comments here in the last 48 hours or so. So we really do have to be cognizant of the potential for a margin squeeze here. And that, I think, has to be on the Fed's radar. Again, it is business investment and not consumption. Despite consumption being a record 71% of U.S. GDP, business investment has always led the U.S. economy in and out of its cycles of expansion and recession.
I'm looking at the WIRP function, Danielle, on the Bloomberg terminal, the world interest rate probability. It looks like the market's pricing in maybe just a little bit more than 2 rate cuts this year.
I feel like it's always all over the place, though, when we look at that function.
It is. And I have, not a whole lot of confidence in it. Not to say it's not very representative or interesting and useful, but boy, it's all over the place. But a little more than 2 rate cuts this year, Danielle. Does that seem reasonable to you?
I really think we're going to see maybe double that or more.
Wow.
We're setting up for the September meeting a lot like, we're setting up for the May meeting a lot like we did in between July and September of 2024. Some non-farm payroll reports are a little bit lagged in terms of their release. The April report is actually released on May 2nd. So that is 5 days before the Fed meets again, but during blackout. So the Fed's going to have to be very, very cognizant of its employment mandate, because I think that in particular is moving in such a way, the momentum, we're seeing it with fewer jobs in the consumer confidence report. We're seeing it with 66% of Americans in UMich saying that they anticipate the unemployment rates going to rise in a year. We've never been at these levels, whether it's Conference Board or University of Michigan, when the U.S. economy has not already been in recession, looking through the rearview mirror.
All right, and we're going to get some more new University of Michigan data this Friday, so we'll be having that for you as well. Danielle DiMartino Booth, she's the CEO and Chief Strategist at QI Research, one of the smarter folks we talk to when it comes to all things Federal Reserve and kind of how the Fed's trying to deal with current economic conditions.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
The next move the Federal Reserve will take may be a hike this fall. You don't see that every day, so that's where I want to start. Skyler Weinand joins us, CIO of Regan Capital Management, down at the Hedge Fund Hotel down in Dallas, Texas, the Crescent Court. Spent many a day there. Got tons of II votes there. Stayed at the hotel there. It's a good place to be. Skyler, talk to us about kind of how you're approaching the market these days. We've had that 10% pullback in the market, got people's attention. We've bounced off that a little bit. Where do you think we go from here?
Long term, up. For sure. It's going to be volatile, but what we're seeing is that the consumer and corporations in the U.S. are still so strong. Corporate leverage levels are the lowest they've been in recorded history at about 20%. And consumer balance sheets are extremely strong in aggregate. You're looking at $160 trillion of net wealth in the United States. A lot of that has come from the stock market and real estate. And so, that spending is going to come. But for right now, people are a little bit nervous. Corporate activity, corporate M&A are in the same boat as consumers. But long term, we kind of see this market running for at least the next 3 to 4 years based on how much dry powder is available for consumers and corporations.
So you're thinking a potential hike maybe in the fall. What would need to happen in order for that to occur?
It's already happening, right? So look at inflation. Look at what was really interesting about the recent Fed meeting a week ago was not only, the presser and what they did, but if you look at the dot plot and if you look at their predictions, they make those predictions once a quarter of where GDP is going, where PCE is going, and where inflation's going. They're predicting PCE to actually, it moved up from December to March. And they're predicting that rates, inflation's not going to fall below 2 for years, 2+ years. They're predicting unemployment to actually fall. So unemployment's coming down, inflation's going up. Those are their 2 mandates, right? And so there is absolutely, no one can make any reasoning for me as to why they would hike in this environment. Okay. Yes, financial conditions are restrictive. They're saying they're fairly restrictive right now. But if tariffs come to boot, and if that causes inflation, we're going to see another, Paul Volcker type of moment where they're like, all right, we need to get this under control. We need to hike back up to, 4.50 to 5%.
So given that backdrop here, we've gotten, I guess, a lot of noise that the markets have to deal with on a short-term basis with policy decisions coming out of Washington. Are we embracing risk in the equity markets? Are we embracing risk in the fixed income markets? Or are we kind of just holding back a little bit?
On the fixed income side, you still have to stay short. Okay. The Fed cut last September, roughly 6 months ago. Fixed income has not done very well since then. The ag was up 1.25% last year. It's up about 2% so far this year. So the ag's done okay, but from September to today, it's down. Okay, so it's basically flat. So, and if you look at the shape of the curve, you're not getting paid. You can sit there in cash at 4.30. You can buy agency government guaranteed mortgage bonds that are floating rate at 5.25. Okay, so you can get paid 5 handle yield to sit there, and the belly of the curve's inverted.
International. A lot of people are talking to me about international markets, and they've had such a good start. European markets in particular this year. How do you guys think about the U.S. versus non-U.S. these days?
Well, part of that's due to the dollar. The dollar's come down. If you look at Asia, for example, Asia's not done very well this year, but dollar adjusted it has. So that's part of it. But so that's helped out Europe a little bit. But, Germany announces that they're going to turn the printers on and they're going to issue tons of debt. And going back to World War I, Germany is a very austere economy. Yep. And now all of a sudden, based on the Ukraine war, all right, we're going to see a ton of debt printing. And so that's really ignited certain sectors, obviously like defense. So yeah, it pays to be, well diversified, both in terms of, equities, but also in terms of locations as well.
How long does that story last for international? Just because they underperformed so much relative to the last year, and especially the last 2 years of the bull market run and the S&P 500 because of what was going on with AI. And obviously these other corners were cheaper, but is this something more temporary that you think is going to happen more internationally?
For sure.
Or does it stick?
Yeah. So, we're a couple months into the administration, 2.5 months, right? And they came out, the administration came out and said, hey, look, we're going to break some things for the first 100 days. So what do we got? We're halfway there. We're halfway to 100 days, basically. So, 3-4 months into it, we got a couple months to go before the spotlight comes back on the United States and volatility decreases. We're seeing that in the VIX. VIX almost hit 16 handle yesterday. Yep. And so when that volatility subsides, I think the spotlight comes back onto the U.S. It comes back onto the big Mag 7, tech, AI, you name it.
30 seconds left. Earnings. What's your view on earnings? Can we depend upon earnings to drive this market?
No. So earnings will be there, but at a decreasing rate. Okay. So we've had a gangbuster 3 years, right? In, 2.5 years. So earnings will be coming down on a year-over-year basis. We can't continue to produce just gangbuster year-over-year earnings. And so, yeah, maybe the stock market ekes out 5-8% this year, but above and beyond that, seeing the 20+% that we saw the last few years, that's not going to happen.
Right. Very good. That's kind of what we've been hearing from a lot of folks, looking at an earnings growth rate or stock market return rate of kind of mid to high single digits as opposed to the 20-25% we've seen over the last couple of years. Skyler Weinand, thank you so much for joining us. Skyler Weinand, he's the CIO, Regan Capital Management. They're based down there in the Big D, Dallas, Texas, but he's joining us here live in our Bloomberg Interactive Broker Studio.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Joy Yang, Head of Index Product Manager at Market Vector Indexes, joins us here in our Bloomberg Interactive Broker Studio. Joy, are you surprised we're not seeing a higher level of the VIX, given some of the uncertainty that I think a lot of investors feel so far this year?
Yeah, thanks for having me. Yes, I think it's undeniable we're in a period of heightened uncertainty, but uncertainty is actually quite hard to measure. And as you mentioned, when you look at the VIX, it's unusually low for what we should expect in a fear-oriented market. But if you look at the Economic Policy Uncertainty Index, that's shooting straight up, and it's at its second time high. And I think this is reflecting two kind of very rational strategies that we're seeing in the market. One is this kind of wait and see, because people just don't know what's going to happen next, and they've been burnt previously. So I think they're going to park their assets in something liquid and be ready to pivot very quickly. So that's gold, and we're seeing this all-time high in gold.
Thank you for pointing out this U.S. Economic Policy Uncertainty Index. I wasn't that familiar with it, but you're right. It is now screaming higher. Baker, Bloom, and Davis are the source there. So if you're in front of a terminal, just type in, U.S. economic uncertainty, and you'll see this index, and you can graph it, and it says, oh, yeah, that's a thing.
And to your point, Paul, because you were talking about the VIX, when I was talking to a lot of traders, especially once it got close to 30 intraday earlier this month, a lot of them didn't want to pay for puts above that because it just would have been too expensive. So I was curious, Joy, your thoughts on the dynamic there and what that tells us, because we still see realized vol picking up.
Yeah, so I think, this is just kind of this lull before we get clarity. And I think we're getting clarity on April 2nd, maybe, possibly.
Right.
But people want to stay invested. You really don't want to be holding cash. So staying invested means buying something that's liquid, but will still offer you either a hedge or some growth opportunity. And that's gold right now. It's at all-time high. And we're seeing a lot of flows into gold and gold ETFs.
And gold up another $6 here today, $3,061. I go back to the Goldman Sachs call maybe a month ago, 5 weeks ago.
Yeah.
3,100 on gold when it was at 2,800. Great call there by our buddies at Goldman Sachs. A lot of money's going to international stocks, including Asia, not just Europe, but Asia as well. Is that a trend or is that a trade, do you think?
Well, if you go back and you see this other kind of strategy people are playing is, we don't know what's going on, but we do know that, U.S. markets have been up unusually high. So I think that's really kind of the unusual period, not this correction that we are seeing, but up 20% over 2 years. So let's go back to maybe focusing things that we do know, which is, markets are volatile, but let's look at fundamentals. So when you look at fundamentals and you think that corrections are a good time to buy, well, Europe, Asia, they've had bigger corrections than what we've seen in the U.S. And if you look at fundamentals, the companies that are trading in these markets, whether it's Alibaba or BYD, they're trading at, half the PE of their American counterparts. So that's a great buying opportunity. And the same with European, whether it's European defense stocks, European other, any other industry you're looking at.
Yeah, those European defense stocks really taking off, and a lot of them, when you're looking at those PE ratios, being a lot cheaper than some of their peers more internationally. How long do you think that can continue? Is this something more shorter term, just given their underperformance in recent years relative to the U.S. and that first 2-year bull run fueled by AI?
Well, this is definitely a structural shift because, the U.S. message was very clear, whether intended or unintended, as we saw in text messages this week, that we're not going to go out there and support the rest of the world, right? So, the Europeans are looking at this and they're reinvesting back to their own military autonomy. And we know that government defense spending is fiscal stimulus, right? But it's big and it's long. So these are big structural, dynamics, and we think that European defense stocks, which have already been up double digits year to date, will continue because there's going to be more to come. But I would also say don't discount U.S. defense stocks, because I think the rest of the world still needs some of the technology, and I think warfare has moved from ground to air to cyber security. So companies like Palantir, which are AI intelligence, are still going to be quite important in this space.
I look at Alibaba for a variety of reasons, one of which is my good buddy's the co-founder there. but it is for me at least, a proxy on how investors view the Chinese stock market. If they like it, Alibaba's going to move higher. If they don't, like it's been for the last several years, it's going to move lower. The stock's up 56% year to date. Do you feel comfortable in the Chinese stock market these days?
Well, if you look at, stocks like whether it's Nvidia or Amazon, they're up double digits, if you look back 12, or 2 years. And I think this is part of, what we tend to forget when we focus so much on one country, one stock, is that necessity is the mother of invention. And, innovation will happen anywhere. Competition will shift innovation to where, it's going to surface. And I think Chinese stocks are, they've been kind of quiet in the background. We've forgotten to look at them, and now they're visible, and we've just noticed, they've been doing things also, within, their own area.
Yeah. So again, Alibaba, 56% year to date, up 85% over the trailing 12 months. So people paying some more attention to the Chinese equity markets. Joy Yang, thank you so much for joining us. Head of Index, Product Management, and Market Vector Indexes.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
What I've noticed is institutional buying and institutional embrace of crypto seems to be pretty interesting to me. Aisha Kiani joins us. She's the COO of MNNC Group. She joins us here in our studio. I'm looking in Fidelity is, raised, it has assets under management grew by over 40%, $8 billion. BlackRock is into the crypto space. What are some of the latest trends in crypto that you're following now that we presumably have a pro-crypto presidency and administration?
So it all started a couple of years ago, but now given the administration change, right, we have a bit more acceptance to it. And given the regulatory change around it too, or at least on, the commissioner levels, we have started seeing a lot more institutional entering. So we have started seeing more stable coin buying, right? And basically trying to have a bit more stable coin exposure. The other thing is, obviously, we're seeing large Fortune 500 companies buying BTC or stable coins, on their balance sheet. We see almost everyone saying that they're either looking to, build a blockchain or working on a private blockchain solution for their company on how to decentralize their data. So yes, we have Fidelity, we have BlackRock. We have seen a lot of conversations around tokenizing assets. BlackRock is obviously spearheading that effort. But yes, we are seeing a bit more acceptance that we've seen in the past.
Walk us through some of the regulational changes, because that has been a big criticism in recent years about the lack of regulation. So how have things changed?
So over the years, right, we heard large banks saying that, look, we cannot trade this asset because even though it's for us, it's just a ticker, right? We don't know how SEC or CFTC would treat it as, right? What has happened in past month or so is that SEC has literally, let go most of the enforcement tasks that were going after crypto companies. One, all of the SEC charges have been dropped against Coinbase, Immutable, MoonPay, all of the companies that were open. So that has changed this shift. Same thing with CFTC. They've tried to set up, co-working groups just to focusing on digital assets. So even if crypto or blockchain or Bitcoin as a whole doesn't get a special category under digital asset, it'll probably be just treated like another asset under SEC. Just the same investor protection, just one of the stocks that you could trade on the market.
Is that where you think we're going to go? Because I would think that's where the industry would like to be, right?
That's where the industry would like to be, absolutely. But we would see that's where it is headed. Yes. Okay,
so that's good news, right?
Yeah.
So, is this administration perceived still as pro-crypto, or maybe they just don't care, and that's okay too?
No, very pro-crypto.
Okay.
Very extremely. We had an industry conference here in New York last week, and not as big as Consensus or, a couple of others. And President Trump had a recorded message.
Yeah.
Yes, had a recorded.
We carried it.
Yeah. So we carry, exactly. So, and then, World Liberty Financial, the organization under him, they're buying tokens consistently. Yeah.
Okay.
It's interesting too, because if you're just looking at its performance year to date, still lower here, close to about 6%. So, I mean, what's the deal?
It's dead. I mean, honestly speaking, as hyped, I'd be very honest about this. As hyped, we have basically done with the industry in past 3 to 4 months, right? Ever since the administration changed, we haven't seen new volumes come in. And we haven't seen new liquidity come in. We haven't seen a lot more large institutional just plug in and say, here's the capital, just go trade.
Why do you think that is?
Because I think at the end of the day, in months or so, everyone rather manage their own book than handing to like crypto native funds or plugging into.
All right, I don't know anything about this, and I take great pride in not knowing anything about this. I come from the day of trading blocks of stocks. Has the story kind of faded here for crypto? It feels like the momentum is maybe out of the story. We don't talk about it as much as we used to. I quote it, but when I quote it, like I'm quoting stocks and bonds, I feel like, should I even be quoting Bitcoin? Does it feel like the momentum's fading?
I think we're not as special as we used to.
Okay.
You're right there, but we're not as special as we used to. We were a hedge against inflation. We were, one of that digital asset that you could buy so your grandkids could be proud of it.
But like, for the criticism against that being a hedge against inflation, I mean, that clearly didn't work in various instances over the last 3 years during the Fed's hiking cycle to try to tame inflation.
It worked in 2020 and it worked in early 2021. Right now, it's just following the macro, and which it shouldn't have. If it had followed its initial narrative, it was, we're an asset class of its own. Right now, we're just treated like another tech stock.
So what's the next big issue or big milepost for the crypto space? Is there something, piece of news out there that we're waiting for, whether it's a piece of legislation, whether it's a new product offering? What's the next new thing?
I think we are getting everything that we've ever wanted, right? We are getting, a bit more understanding from regulators. We'll probably even have stablecoin legislations come in. I heard that a lot at like Milken Symposium a couple of weeks ago. We're going to see, stablecoins being integrated just like, dollar into like large banks, or large banks issuing their own stable coins. I think we're slowly progressing there. My internal skepticism is always, is the tech ready? But I could go on that for days. But I think from the regulatory perspective, from the market's perspective, we have accomplished,
But are the kids at NYU that you talk to are they still crypto this, crypto that, crypto this? I want to go into crypto. I don't want to go to Morgan Stanley and be an investment banker or a trader. I want to get into crypto. Are they still saying that?
50% split, because the other 50% have moved on to AI. So
AI.
Yeah. So
Okay.
my course is still very popular. I still have the wait list, everything. I still have kids building under me, writing under me. But now it's like, hey, professor, this is cool, but let's talk about AI also. So.
See.
You had mentioned, we only have about 30 seconds left, but what was the issue with the tech that you were maybe skeptical about?
I think that if you really break it down with Ethereum or Solana, or like, if you come on chain levels, can we handle that kind of volume, right? Like, as I remember on my first show with Tom, he said, I mean, none of this makes sense. So, but I don't know why this asset is trading at 70,000. So please, clarify that.
Yeah, then it went up to a high of 100.
Exactly. And Paul kicked in and Paul said, why don't you teach us? So we're like, why?
Exactly.
So that's the thing. Like, for in order to be at 110 again, is the tech enough?
Okay. Aisha Kiani, COO of MNNC Group.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Let's get a look at those newspapers with Lisa Mateo. Lisa, what are you looking at?
All right, so remember when Elon Musk put out the request of federal workers to submit those 5 bullet points detailing their week's work,
I'd have a
right?
challenge doing that.
Yes. Well, a lot of workers have been doing it, but now they're running into an issue, and the issue is apparently the inbox is full.
Oh.
So their emails are getting bounced back. So now they're putting in this effort, but it's not going through. So what the workers are being told, so for example, you have the Department of Health and Human Services, they're telling employees that, okay, we know what's going on. So they're directing them to send their weekly 5 things emails to a different OPM email address. Even NASA unveiled this app so that workers could send their reports there too. So they're doing all these different things because remember, he had said that workers would be fired if they didn't reply. I mean, the White House kind of, pulled back and said, you know what, let's explain, we'll leave it up to the leadership of each agency to determine, that.
Do we
kind of
know
thing.
who's presumably reviewing these emails to say, are these 5 things you're doing, are they good or are they
That's a good
bad? Are they
question.
evaluating what you're doing? Is there anybody, do we know
It's
who's
a
reading
great
these
question.
emails?
Well, now they're getting bounced back, so
Okay,
who knows?
so we're not even
who's
there yet.
getting them.
We're not even
But no,
shocked
it's
there.
a good question.
All right, what else we got?
Okay, so we talked about the housing crisis, right? What it's doing now is that it's sparking new alternatives to building homes. So we're talking about builders using everything from 3D printing, assembling homes inside a factory, and then using hemp to make building blocks for walls. So this is from the Associated Press. They visited this factory where they're pumping out 500 homes in just over 3 years of operation. Each takes about 5 to 7 days to build. Okay, so they're inside this factory. They get everything, the walls, the wiring, the plumbing, the countertops, and then they're shrink wrapped and shipped out.
Wow.
So this is like how they're pumping it out there. Then as far as the 3D printing, they make like these curved walls that are unlike concrete blocks. But the only drawback is that it's pricey, right? 3D printers are expensive. The engineers to work them are expensive. Other skilled employees are expensive. And then this hemp and lime mixture. I did not know this. It's called hempcrete. Okay. And it's this natural insulation. It's mold, fire resistant, acts as this outer wall of insulation. You still need kind of like the woods and the frames, to build the walls. But it basically cuts down because it replaces 3 wall building components with just 1.
All right. I don't understand how we got into this where we don't have enough housing. Like we're not. People aren't having children anymore. I mean, the birth rate is way down. Are we knocking down homes such that we don't? All I see when I drive around is these multifamily housing units being built everywhere.
You didn't use 3D printing for the Sweeney compound?
I just don't understand that the fundamental concept why we have a housing shortage.
I guess people just don't want to give it up because you have
if you locked in
as a 2%
rates around 2%, tell those boomers
you walk over
leave
to
so I can
Brooklyn
get a
and
house.
they're building all over the place.
They
walk into middle America, they're building these multifamily units all over the place.
Yeah. It's expensive.
I don't understand. So that's I'm not buying this. There's not enough homes out there. That's my thing.
He's not buying it.
I'm not buying the whole concept. All right, what else we got?
All right, last one. Meghan Markle's new Netflix cooking show. Not sure if either of you have seen it, but apparently it's gotten, critics are bashing it and saying, what does she know? But what they love is her fashion. It's called With Love Meghan. So apparently she has this fashion selling power that everything she wears, like dresses, shirts, vests, cashmere cardigans, they all go viral and people buy them and the stores are getting sold out. They're going on wait lists.
So you guys are not the demo for this?
I guess not.
I actually haven't seen the show yet,
No,
but I saw a
neither have I.
promo on Netflix.
It looks beautiful.
Yeah.
Like it does. And I do like what she wears. I don't know if I would buy it or be able to afford it for that factor.
Yeah.
But I mean, she's also starting like this Shop My page where she can actually make affiliate revenue from these things. So she's kind of turning her own thing.
So this is a cooking show, right?
It's a cooking / like she gardens, she entertains, like it's a lifestyle.
Okay.
There you go.
All right.
A lifestyle show. And apparently it got renewed for a second season.
I'm not down on Meghan Markle like everybody else is. I have no opinion one way or the other, but we'll have to see. All right. Lisa Mateo, newspapers, thank you so much. We appreciate that.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.